So welcome everybody to the Texas REIAs. And we're going to give you guys, we're going to start this evening with a market update, and then we're going to do a commercial real estate presentation and talk about how to get started in what's going on in the commercial real estate. So welcome to the Texas REIAs. The Texas REIAs is the largest by far network of real estate investor associations in the great state of Texas. Over 150,000 members, participants, and attendees across the state going back to 2003. If you have the slightest interest in getting involved in real estate, the first thing you want to do is you want to join your local real estate investor association, because that's where you meet other investors, that's where you get local training, access to money, resources, market data, and virtually everything you need to be a real estate investor, either residential and commercial. Among the various resources that we provide to real estate investors is market data. And I'm going to share a little market data with you guys right now. Now, what's the biggest story when it comes to real estate? What's the big change that happened over the last few years in real estate? What happened? Interest rates. Yeah, interest rates. What happened to interest rates? They went up. They went up. So what do you think, guys? Let's get a little audience participation here. Would you say interest rates are high, or would you say interest rates are low? You only have two options. I'd like to get everybody's vote. There's no right or wrong. It's just your opinion. Who thinks interest rates are high right now? Who thinks interest rates are high right now? Who thinks interest rates are low right now? Who thinks interest rates are low? Okay, my opinion, they're low. Okay, well, actually, I'll tell you, my real opinion, they're normal. Okay, I've been buying rental properties in Texas for 21 years. Most of my rental properties have a mortgage 6.5% to 7.5%, which by historical standards is normal. Now, a couple of years ago, interest rates got as low as 3%. Before that, prior to that, when was the last time before that interest rates got to 3%? 30 years? No. No. The answer is never. Never in your lifetime, not in your parents' lifetime, not in your grandparents' or great-grandparents' or great-great-great-grandparents. It never happened before. When is it going to happen again? We don't know. My guess, never. In your lifetime, your kids, your grandkids, your great-great-great-great-grandkids. It's a 1 in 1,000 years. I mean, the thing that would have to happen to make interest rates go back to 3%, yeah, you probably don't even want to live on that planet, because you're going to be more worried about the zombie apocalypse than you are about interest rates. Okay? It's not normal. And I like normal over not normal. Right? And people are like, we talked about this earlier, some people are like, houses are expensive. Houses are normal too. Everybody every year for 20 years that I've been doing this thinks houses are expensive. And every year they become more expensive, and everybody complains they're so expensive. Yeah, it's crazy. Right? But I like normal. Sometimes it's easy to buy and hard to sell. Sometimes it's easy to sell and hard to buy. It's never easy to buy and easy to sell. But when the market is normal, it's easy enough to buy and easy enough to sell. And that's where you make a lot of money. When things are abnormal, it's not normal. I'll give you an example. Commercial real estate. We're going to talk about commercial real estate. Commercial real estate are typically 5-year deals. So a couple of years ago, multifamily apartment buildings, very hot. People were paying top dollar because it was hot and competitive. So people were buying these apartment buildings with top dollar, right, paying top dollar. And then they would finance them with a 3% mortgage. And, you know, at 3% mortgage, they could collect enough rent to pay the mortgage. But commercial loans are not 30-year loans. Commercial loans are 5-year loans. And they don't have to be, but typically they are, right? And that means all those properties got those 3% mortgages, they're all coming due, right? They're having to refinance. And you can't get a 3% mortgage. Now the mortgage is 6.5%, 7%, right? And the same property generating the same rent does not generate enough rent to pay the mortgage when the mortgage goes to 6.5%, which is normal. So when you're doing a commercial deal, you have to ask yourself, what is the market going to look like 5 years from now, right? If the market is in a place it's never been before in the history of the world, is that a reasonable thing to expect? No. If the market is at normal interest rates, is it reasonable to expect that 5 years from now, the interest rates will probably going to be 6.5% or 7%, or maybe even less? I would say that's a much better bet, right? So that's why I like investing in normal markets. I'm scared of investing in abnormal markets. So another question, when interest rates go up, what happens to home prices? You think they go up or think they go down? Who thinks when interest rates go up, home prices go down? Who thinks when interest rates go up, home prices go up? A lot of you are not voting. There's only two options. They go up and down. They go up and down. Real estate doesn't care about interest rates. Real estate cares about supply and demand. Okay, so only things that affect supply and demand. Now, sure, for sure, when interest rates go up, homes are less affordable, which means fewer people can afford them, which means demand has gone down. But something else has changed. Supply has gone down. Why has supply gone down? Normally, when you look at the market, normally 2/3 of the houses for sale in the MLS are resale and 1/3 are new construction. Right now it's inverted. Right now 2/3 of the houses that are selling are new construction, only 1/3 are resale. People are not selling their houses. Why? Because they got the 3% mortgage and they don't want to give it up, right? So right now people should be saying, hey honey, let's get a bigger, nicer house. Nobody's doing it. They're not moving up, right? Because they don't want to lose their mortgage. So all of that supply is being held off the market. So we have less buyers for sure, but we also have less sellers. And because of that, the market didn't go up, it didn't go down, it actually went flat. And that's why. This is an interesting chart. Interest rates versus home prices going all the way back to 1970, right? From 1970 to 1981, interest rates on mortgages got all the way up to 18%. So anybody that thinks 7% is high, what about 18%? No, that's high. Yeah, and when interest rates went up, what do you think happened to home prices? They actually went up. Remember, interest rates pushed prices up and down at the same time. A little more up than down, interestingly enough. Right? When interest rates came down, what happened to home prices? They went up some more. And when interest rates went up and down, what happened to home prices? They continue to go up. Now, there's bubbles. That's 2008, 9, 10. There's bubbles, big bubbles, little bubbles. So it's not a linear graph, right? It's changed. But it's not as simple as to say interest rates make home prices go down. Interest rates push down, supply limitation pushes up, and then they offset each other. And if you want to look at where we are now, the market is flat. Like flat as Texas is flat. So I'll give you a little data, and we'll do a commercial presentation. The average price house in Texas, $417,000, up 0.3%. It's flat. Over the last year, it's flat. Median price, $339,000, up 0.3%, also flat. Now, the most important number to read is this number right here, months of inventory. Let me explain what that is. Months of inventory. If you want to know what's going on, you look at the inventory. Okay, what is months of inventory? One way to explain this would be like this. If you stopped adding any more houses for sale, the MLS, that's all the houses for sale, stop adding any more. No more houses to add to the MLS. We're just going to sell what we got until we're out, until the shelves are empty. How long would the inventory last? And the answer is 4.8 months. Now let me put that in perspective. Anything less than 6 months is considered a seller's market. Anything more than 6 months is considered a buyer's market. Right around 6 months is normal, and that is a normal, neutral market. We are still in a seller's market. Now people are like, well, the market is not as hot as it was. That is true. 1 year ago, we had 3.7 months of inventory. We had a hot seller's market, and we went from having a hot seller's market to having a lukewarm seller's market, but it's still a seller's market, and that's some perspective. Now, the total number of listings has gone up a little bit. There's more inventory. That's why the number of months of inventory has gone up. But let's look at some history. 2021 prices went up 18% in 1 year, post-pandemic. 2022, they went up another 10.7%. 2023, flat. So the market went way up some more, and then it just flattened out. And that was it. And hasn't done a whole lot since. Okay. Houston. Let me go through Dallas. I want to go through this quickly. Dallas, the average price house in Dallas, $499,000. Holy cow. How can you guys afford to live here? It's flat. Median price, $395, down 1%, flat. Months of inventory, 4 months of inventory. It's the hottest market in Texas. Dallas is the hottest market in Texas. Leases, talk about commercial, lease prices are down 2%, flat. Now, when leases are up and leases are down, what does that mean? If prices are down, what does that mean? That means there's a little more vacancy. When prices are up, what does that mean? That means they're full, right? When prices are flat, what does that mean? They're flat, not really up or down. History, Dallas, 2021 price up 20%, 2022 up another 15%, 2023 flattened out, up 1%, we'll call that flat. So exciting times in Dallas. Dallas, by the way, I don't know why, I invest in Austin, Dallas, Houston, San Antonio. Dallas has always been the bellwether of Texas. If you want to know where Texas is going, you look at Dallas. It's the first one to move, first one to go up, first one to go down. For some reason, something about the mix of the economy or whatever it is, it's always been the bellwether. And it's one of the things we look at when you're looking at the data. Like we also look at condominiums. Condominiums, we call condominiums the canary in the coal mine. First thing to go, last thing to come back. So if condos are high, you know, if you can sell a condo, you can sell anything, right? But as soon as the market starts to soften, the condos go first, right? So you want to look at like leading indicator, look at like condominiums in Dallas. That'd be a leading indicator. But yeah, so I just wanted to kind of go through Dallas. I'm going to skip Austin, San Antonio, but let's talk about drivers. You know, what's driving the market? Like the economy. Economy is pretty good. Not bad. I mean, the real estate doesn't really care about the economy, but it cares a little bit. Like consumer confidence. Consumer confidence is an interesting number. They measure it on a scale of 0 to 200. How confident are you? And anything over 100, people are confident. Any people under 100, people are scared. Right now, we're kind of right at 103. We're just over the middle. People are a little bit confident. Unemployment rate, solid. Anything under 5% unemployment is solid unemployment, full unemployment. Texas, 4% unemployment. People have jobs. They're a little more likely to buy real estate. Job growth, again, Texas is solid. Great economy, great employment, great jobs. Stock market, now again, real estate doesn't care about the stock market directly, but it cares indirectly. If people look at their 401k and it went up, they feel wealthier. And when people feel wealthier, they're a little more likely to buy real estate. So it has an indirect effect. And business growth. Business is exploding in Texas, greatest economy in the country. So those are all encouraging. These are things that are pushing the market up a little bit. Housing availability, affordability, interest rates. Okay, that's a problem. Interest rates went up, and that's pushing demand down. House price trajectory is flat, not really going up, not really going down. But affordability is definitely pushing down. So the economy is pushing up a little, affordability is pushing down a little bit. Housing supply. Active listings are flat, not really going up. We're just kind of adding at a moderate pace. Months of inventory is actually pretty good, 4.7 months of inventory. We are in a seller's market still here in Texas. Housing permit projector, we're not building enough housing. There's a problem, a big problem. We're not building enough houses. You know, money's gotten a little harder, permits are a little harder, supplies are a little harder, and how many of you have heard this? You know we're in the middle of a national housing shortage? Who's heard of this? Yeah, we have 6 million fewer houses than we need for the number of people that need a place to live in a house. So we have a shortage of houses on a national basis, and that's putting price pressure up. That's pushing prices up. Construction labor growth, got a problem. General contractors are dying. They're dying out. They're too old. The average general contractor is like 58, 59 years old. They keep getting older, and kids are not becoming contractors. So if you have a teenager, don't send them to college. Buy them a hammer. Yeah, I'm serious, man. Do you guys have any idea how much general contractors make? A lot more than surgeons. Yeah, with no student debt, not having to work with some jerk, right? So yeah, give them a hammer. They'll make a lot more money. They'll work for themselves. They won't have to work for a jerk. They won't waste 4 years of their life in college. They won't have any student debt. And you're talking to a guy that went to college. My parents went to college, and now I'm a father, and I have a kid. I'm buying him a hammer. Yeah. I mean, I don't have a problem with college, but there's things you can do. I'm just saying, like becoming a contractor where you can make a lot of money. Okay. And then finally, housing demand. Closed sales trajectory down a little bit, starting to turn around. Pending sales trajectory is flat. This is a big bullet, though. I made this bullet like a triple-sized bullet, migration. Not all of these things are the same, but this is a triple-sized bullet, migration. What is migration? Migration is the ratio of people moving in versus people moving out. Population growth. Remember supply and demand? Last year, California lost 500,000 people. Last year, Texas gained 500,000 people. Where do you think they went? Yeah, pretty obvious, right? And then we got another 5 or 6 million people. We don't know where they went, but a bunch of them are here too, right? So the point is there's millions of people, right, that are moving to Texas, living in Texas, whatever. We have a huge influx of population, and they need a place to live, right? And we're not building enough houses. So all of this is upward pressure on pricing. So we got some downward pressure, we got some upward pressure. And by the way, one little disclaimer, and I think I have one more bullet here. Wild cards, interest rates, right? A little election just happened, right? What's that going to do? There's a couple of wars going on. Those are, I guess you could call them wild cards. But these are things pushing up, pushing down, and pushing sideways, right? These are the things that push on the market. So what do you think, guys? So let's do a poll of the audience. Who thinks prices are probably going to go up? Who thinks prices are going to go up? Who thinks prices are probably going to go down? Okay, got a couple of downs and a bunch of ups. I'll give you our forecast. And by the way, we're not here to try to promote a particular opinion. There's groups out there like the National Board of Realtors. Every year the market's going up, the market's going up. Every year for 40 years, the market's going up, right? Sometimes they're right. When we think the market's going up, we'll tell you it's going up. When we think it's going down, we think it's going down. Because we have strategies for up markets and down markets and sideways markets. So we just pull data, right, and we give you the data. But you have to be a student of the market to be a real estate investor. But I'm going to tell you, we've been doing this for years, and our forecast has always been spot on. And it's not because we're rocket scientists. Most of this data comes from the Texas A&M School of Real Estate and some other online sources. The reason we've always been very accurate is because this is not that hard to do. Trying to predict the economy is very hard. Trying to predict the stock market is impossible. Trying to predict real estate, not that hard. And the reason it's not that hard is because we know everything. We know how many people live here, pretty much. We know how many houses we have. We know how many houses we're building. We know how many people are moving here. We know how many we're going to need. We know how many we're going to have. We know everything. When it comes to supply and demand, we know pretty much everything. The only thing we don't know exactly is are interest rates going to go up or down or a little faster, a little smaller. Even the Fed is pretty helpful in giving you some ideas about that. So it's not that hard to figure this out. So I'll give you our forecast. That was it. If you were waiting for the market to bottom out, I hope you enjoyed it. That was pretty much it. It didn't do much. The one thing that's holding us back is interest rates, which have started to come down. A little, not a lot, but a little. And they're probably going to drop another 0.5% to 1% by the end of the year. They already dropped 0.5%, so they'll probably drop between 0.75% and 1% by the end of the year. And that's the one thing kind of holding us back a little bit. But that being said, there's nothing pushing us forward a lot. Because as interest rates go down, more people will sell, more inventory goes on the market, more people will buy because it's more affordable, and you factor all that in, we don't really expect a whole lot to happen. We'll probably be maybe up 2% by the end of the year, and that's about it. So hope you enjoyed that big down market, but don't worry, it's going to pretty much stay not doing a whole lot, and I like that. So a little other data. Multifamily commercial, cities with the strongest absorption, right? Dallas, Houston, okay, Austin, You know, all of them are in the top 10. Those cities people are moving to, people need to have a place to live. There's a little bit of shift away from home ownership because high interest rates makes homes a little less affordable, but everybody's got to live somewhere. So if they're not able to afford a mortgage on a house, they rent an apartment. And that's why there's a lot of people, and the demand is really gone up in these major markets here in Texas. Now, we've also been building a lot more supply. So a lot of new apartment buildings have come online over the next year. So we got a lot more demand and a lot more supply, and they've kind of balanced each other out. Rents have risen, but only a teeny tiny bit. So rents are basically flat. A few other data points. Office, there's a lot of vacancies in office. I don't invest in office space. You know, COVID really hurt, and a lot of people don't go back to work. But then there's all kinds of big, huge trends, right? People are working remotely, people are working online, you know, and people are working from home, and, you know, for lots of different reasons, office is just not coming back. Retail's doing pretty well. Dallas, Houston, two of the top 10. Austin, all in the top 10. Industrial's doing pretty well. Dallas, Houston, again, followed by Phoenix. So Texas is definitely the state you want to do commercial real estate in, and it's a great place to be a real estate investor, either residential or commercial. Self-storage. Self-storage has become really hot. I'll do a deeper dive into self-storage. Self-storage has been revolutionized. And the reason is it used to be you'd build a self-storage facility, you have to hire some guy to sit there 24/7 and watch the place. The guy's gone. He's been replaced with security cameras and an app. So you literally can run a self-storage facility from your phone, right? When people check in, you can open the thing remotely, gates, cameras. When they leave, clean it, take a picture, upload the picture, and if it's room swept clean, you get your deposit back. You know, the whole thing is run remotely. And because of that, the demand for self-storage from real estate investors has really exploded. Now, there's also a tie between self-storage and home sales. Home sales are down. Every time people move, they get a storage locker. Like, we're moving from one house to another, so they put some stuff in storage, and they usually leave it there for years. You know, I always joke, self-storage is where you spend thousands and thousands of dollars to rent a locker to store a couple $100 worth of stuff, right? I mean, it's like, I'll tell you, I moved, gosh, what is it, 15 years ago I moved, and I did a funny thing. I moved from a 5,000 square foot house to a 1,000 square foot house to a 10,000 square foot house. The 10,000 was not ready, so I went from 5 to 1 to 10. And when I went from 5 to 1, I needed to put a bunch of stuff in storage. And I thought, well, you know what I'm going to do? I'm going to get a big shed on one of my rental properties. So I got this big shed, and I put all that stuff in that shed. Instead of getting a storage locker, I just had my own in that shed. So I put all my stuff in that shed 15 years ago. And it's still sitting there. And imagine, like, if I had gotten a storage locker, I'd be paying rent on a storage locker for 15 years. So, but yeah, storage is hot as an investment, but the prices have gone down a little bit because the housing market slowed down. Not as many people are buying, not as many people are selling, and they tend to get a storage locker right when they swap houses, buy or sell their house. That's when storage gets boom. So if interest rates come down, we will expect storage to go up again. Okay. Commercial forecast, I'm going to actually do a commercial presentation, but for sure, higher interest rates have helped increase absorption rates. You know, when interest rates go up, what happens? Cap rates go up and values go down. When interest rates go down, cap rates go down and prices go up. So if you're investing in commercial, you really want to invest when the interest rates are in a down trajectory, not on an up trajectory, which is exactly where we are right now. I was not very excited about multifamily a few years ago. When it was hot, I didn't want anything to do with it because the interest rates was nowhere they could go but up. And I knew a bunch of people would get stuck overpaying, financing them with a 3% mortgage, and then not be able to refinance them when the interest rates are up and the values go down because the cap rates get compressed.